Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with his good friend of the channel, Mr. Greg Dickerson. How you doing, sir?
Doing great, Michael. Good to see you.
Nice to see you as well. So something I have coined, really, I got to give you credit for because you gave me the inkling for what we're about to talk about. So let's set the stage. There's no question that interest rates are going up, that the cost of capital is going to be higher. We are starting to see what the Fed has to do, which is called demand destruction, right?
And their next rate hike, is that coming this month?
May 4th.
May 4th. Okay. So no rate hike in April. That's what I thought. I looked at their meeting schedule. They don't have a meeting this month.
No, May 4th. It'd be May 4th and June 16th.
Yeah.
So we are seeing demand destruction. Again, folks, the Fed controls the cost of money, the front end. And as they raise rates get up, you do less deals. So I believe that is going to impact the housing market, right? Because less people are qualified. It impacts the demand side. Here is something that I think is shocking. Rates went up so fast in such a short duration off of such a low base. And the Fed stayed too low for too long, Greg. I believe something.
And you're talking about mortgage rates.
Correct. Mortgage rates. Sorry. Yes, absolutely. I believe the Fed has inadvertently created what is going to go down over the next 3 to 5 years as supply destruction. Let me define that for you because it is a new term. I believe, and again, this is probably homeowners mainly. I believe there will be plenty of homeowners that would naturally be on the home owning scale of first time home, live there 5 to 7 to 8 years, which is average, and then move up. I believe what is happening right now, because 70% of loans have been recast in the last 2 years at rates that generally have a 2 or a 3 on them. Greg, I believe we're going to have a lot of people that refuse to move. They're going to stay with their cheap 30-year money because it is going to be a financial asset that benefits their family forever. Keeping cheap 30-year money, and they're just going to stay put. They're not going to go, because when you move up, Greg, most people spend $80,000 to $100,000 more. Right? Over the last 40 years, rates have generally been going down. So the math was appealing. Now, if you look to spend 80 to 100 grand more, the rate could be double. And people are going to look at that with sticker shock, and they are simply not going to list, not going to move. So I think we're going to have a supply vacuum. And I'll stop there and let you ask some questions.
Yeah. So we're talking about housing specifically, and
Correct.
yeah, we're already seeing that. And, the theory is as rates go up, transactions will drop, values will adjust because the affordability index of the housing goes down.
Correct.
In terms of what people can afford based on their payments. So the theory is that if values go down, then the equity that people thought they had in their house goes down. Maybe their down payment is preserved, but any appreciation that they thought they had is not. So if you're a seller, what are your options? You're saying, okay, I need to sell, I want to move. What is there? I know I'm going to have to pay more in a payment. So that means I can buy less house. What are my options? So the question is going to be, what are people's options? If interest rates are higher and your payments are higher for a house, that's fine, as long as the house prices come down. And it's all relative, because where we were 3 years ago, rates were a little bit higher, but the housing, prices were 30%, 40% less, whatever it's gone up in the last 3 years. So it was relative. So as rates came down, house prices went up. So again, it was relative in terms of, what you could pay. So it's really going to boil down to, and I think at the end of the day, people just don't have to move now like they did before the pandemic. So it's a different lifestyle choice. It's a different demographic shift. A lot of people have already moved, like you said, that great migration has already occurred. And they've locked in at these low rates. So they're likely to stay put because they already made that lifestyle choice in that move. And, right now we're seeing buyer fatigue because there's nothing out there. Interest rates have gone up. Prices are through the roof. So people are just giving up. A lot of people, not everybody.
Yeah, not everybody.
Not every market, but that's what's starting to happen.
Yeah. Again, and this is something, just so you know, I'm asking all my experts. There's actually 8 categories of people. Let me share it with you, because I'd love to get your opinion. And again, these are just wild ass guesses. We're just opinion. Just so folks know, I will be summarizing all of this data. So you can see I've already asked 6 of my experts. Greg will be number 7. So let me kind of lay this out, and we'll start at the bottom at row 9. I believe because rates have shot up so fast, there will be percentages of people that would normally sell that will just simply refuse to. So for example, I believe the largest percentage of people that won't move this in this cycle are what I call move up buyers, right? Normally they would sell their first time home. They would move to a nicer part of town. They would move to a bigger home. They would move to a newer home, something. Now they're going to look at that math equation and say, honey, we don't have an extra $1,800 because the house is more expensive and the debt's more expensive. Why don't we instead make the house we're in nicer, or take a vacation or something else? So
yeah, that's already happening. Add on, renovations and people adding on. And we saw that happen 08, 09, same thing.
So what do you think, again, complete guess, what percentage of move up buyers, and a negative percentage in this case, do you think don't sell, given just it's for most people, it's a bad financial move. So they're just going to stay put. What do you think?
Yeah, I mean, I don't even know what percentage of the market that represents right now, but I'd say, move up buyers, I mean, given the conditions right now, probably 90% of them can't, because there's nothing out there.
Yeah. All right. So again, I was just thinking about supply destruction, all the different areas. So now we'll go to investors like me, right? I own a bunch of homes. I got them at lower prices. I have cheap debt on them. What percentage of investors like me simply won't list? Because A, we can't find anything, right? We can't 1031. A, we've already cashed out, because of high prices. We're just going to keep buy and hold, right? We're going to be Wall Street and just buy these rentals and cash flow them at 6% yield. Do you think investors back off listing homes?
Yeah, especially if values go down, it doesn't make a lot of sense.
Yeah.
To sell. So especially people that bought in the last couple of years that have investment properties, if values change and adjust, then, you won't be able to sell, because again, all you're going to pull out your down payment. So, that will definitely affect. I mean, as far as percentages, I have no idea, because
we're just guessing.
A third of the housing stock is owned by investors, and 1 or 2% of that are institutions that probably will never sell.
Yep.
So what percentage of that group is going to sell? I don't know, maybe 10 or 20%.
Okay. All right. Yeah. I mean, this is just, and again, we're just talking about this one little bucket. Because this little bucket would be the same size regardless. So we'll just say less 10%. Landlords will 10%. They'll sell 1 in 10 less homes. No big deal.
Yeah, and there's other options. Like, a lot of people don't realize, like single family home owners, investors that want a 1031. They can 1031 into multifamily, commercial, other assets.
For sure, I've done it. Yeah, absolutely. Here's one that probably or may not change, because life happens to everyone. I believe some of the sales that will happen this year are called must sell: death, divorce, job transfer. Life happens. It doesn't matter what prices or interest rates, you have to sell when you have to sell, right?
Yeah. And I have no idea what percentage that would represent. It's just that it just is what it is. And
yeah, it's just is what it is. I think. I don't think interest rates make one difference. It's just, if you got to sell,
people have to sell. They have to sell. So 100% of those people are going to sell.
Yeah.
So if that's what we're asking, what percentage of those people? Well, 100% of them, because they have to sell.
Well, this is the delta. This is a percent change. So zero change, whether rates are up or down.
Okay. I see what you're saying.
Yeah. Can't afford. This is a number that goes up this year, I believe. And again, this is a percentage. So I think it's going to look abnormally high, but it's only because we've had no foreclosures for 2 years, right? Foreclosures essentially been illegal for most folks. Yeah. So again, can't afford, no equity. Do you think we have more foreclosures this year? If we do, how big do you think the jump is this year?
No, I don't think so. I think we're still seeing around 5% of the stock is in foreclosure.
Oh yeah. I think it's less than that. Of all housing stock have had a foreclosure filing, I think it's less than 2%.
Yeah. Okay. Yeah. So yeah, so I don't see that changing.
Okay. Yeah. And again, foreclosures take a lot of time. What do you think about flippers? Do you think?
So I think you're going to see a lot of those, and we're already starting to see it. You're seeing people who are, using hard money, and their loan rates are adjustable, and they can't, get financing. Costs are coming in too high.
Yeah.
So you're seeing, a big blow up in that area right now.
So what are you thinking? Because again, I think flippers are going to get hurt. That's what happened last time.
Probably 30-40%, because there's a lot of them that got in and paid these, too much money. They didn't, understand or anticipate renovation costs. So a lot of flippers are getting hurt right now.
How about builders? I think they're going to be up. I think they're going to try to fill in the void, perhaps. I don't know.
Yeah, but still, there's going to be 25% of them that are going to fall out when the contract, when the house is complete because their borrower can't afford the mortgage at the new interest rate. So,
Yeah,
builders will sell. So, they're not going to not sell. So builders will be selling.
yeah. So maybe up 10%.
Yeah.
Yeah. This is the one that I think is very interesting to think about. Downsizing, right? For the longest time, I've heard about baby boomers wanting to sell and trade down. Now, if you're a baby boomer and you happen to own your house free and clear, this probably still makes sense. But if you're a baby boomer who had to borrow money and refi for your college, your kid's college or something, and you're still carrying a mortgage, I don't know that you downsize because it's the same thing on the upway, right? Why would I downsize to a smaller house and the mortgage payment is the same? I mean, again, if you own free and clear, maybe the math is different, but I don't know that downsizing is going to be as big a deal this year. What do you think?
Yeah. I've got friends in that position that would love to sell and downsize, but there's nowhere for them to go. There's no options out there. They're like, what would I buy?
Yeah, exactly.
So it's not even an affordability thing. It's just, there's nothing for them, period, that they would want in an area that they would want. And then you have a lot of people that are relocating and they're going to be forced to do it. So I don't think that metric, I think there's going to be a lot of people that won't sell, probably 20% of the people right now that could sell won't because there's nothing for them to buy.
I totally agree with that. And then the last one I think about is you and I both know a lot of people that have second homes, vacation homes. They're not Airbnb, right? This is just truly second home stuff. Do you think those people look at the housing market and go, hey, housing is hot, let's sell them? Or do you think they just keep them? Or what do you think?
Yeah, I think, it depends. And that's the market I came from and grew up in, and am still in tune with now is a strictly second home, vacation home market. And, you see the boom in those markets when money is good and it's cheap and it's easy. And you see the decline when you get into economic recession. So people will stop buying, which has already started to happen. Those markets are already starting to cool off, second home market, especially the vacation market, because you can't make them cash flow at the prices based on the interest rates. What drove that market was cheap interest because they cash flowed for investment properties. And then, of course, the pandemic moved people, moving into those vacation houses, getting away from where they were. So those two big demand drivers are gone. So you're going to see a lot of supply destruction in that second home market first.
Yeah, I agree.
Builders and second home market. Well, not builder supply. They're still building, but you'll see supply destruction in that second home market first.
Like 20% maybe?
I'd say probably 25, 30.
I'm using
the higher, the
numbers.
faster the rates go and the higher, the more you're going to see a problem, in that market where people are going to want to get out because there's a lot of interest only loans on a lot of those properties.
Yeah, it really is for me, the speed, like we talked in video one, the speed of this rate increase, 250 basis points in the non-QM space in 11 weeks is unheard of.
And keep in mind, so for everybody watching, why is the stock market still doing so well and all that? Because the Fed really hasn't done anything. All they've done is a quarter point rate hike. So you're at 0.33.
Yeah.
And they haven't, they've stopped purchasing assets, but they haven't unloaded the balance sheet yet. So the real effects of what they're doing hasn't happened yet and hasn't shown up yet. So starting in May, you're going to get your first 50-point basis hike, and then probably followed up in June, as well as balance sheet reduction, all hitting at the same time. And then, this is kind of like the tidal wave, right? We still haven't seen the real effects of the inflationary, dynamics that are coming due to the war, due to supply chain, China locking down again.
Yeah.
I mean, there's a lot of that, that's coming down the tide. And then when you add rent hikes and housing costs, people's rents are getting to a point now to where it's affecting their life, their lifestyle choices, their spending choices in other areas, which affects demand, which
absolutely
drives, more of a recessionary environment. So, there's a lot coming down the pike. And, Jamie Dimon came out with it, in his report, to his shareholders recently, and mainly about the war in Ukraine and things. But, we haven't seen the real effects yet of what's to come. And I'm telling you, the markets have not priced it in. A lot of people, disagree with that.
Yeah.
And they think that what we've seen is already pricing everything in. It hasn't priced in what the Fed really needs to do. But more importantly, it hasn't priced in the effects of everything. That has not been priced in yet.
I couldn't agree with you more. Jamie Dimon's letter to his shareholders came out this morning. It's a great read. I read it this morning. It's it left me nervous. Let's just say that about what is
And
coming.
again, it's just repricing, so we've gone through deflation in assets and we're going through it still in real estate. Where's that going to show up first? Second home market and new construction. That's where that's going to show up first.
Mhm.
Year-round homeowners, permanent homeowners, that price is a little bit more sticky, takes a little longer to
For
adjust.
sure. Yep.
But asset prices adjust quickly. We've seen deflation. We haven't repriced yet. That's coming. And when that happens, then you have a floor that's set in for future growth. So it's a good thing. It's a positive thing. It's going to create opportunity, but we're not there yet.
I totally agree with that. Do me a favor. Where can people find you?
Yeah. GregDickerson.com.
Thanks, buddy. I appreciate it.
Yep.